This meeting is being recorded.
Alrighty then. Really the intent of today's session and kind of the instigator for it was, and it's today's session as well as next week, so I'm trying to do kind of a little two-part series here. Hold up. So really the intent of today's discussion and the background on it was we have, and if you guys aren't following kind of a lot of the capital markets right now, the world did sort of shift and change here in the last couple of years. In the last couple of months or so. Getting VC capital in general is hard. Getting VC capital and and walking down that path on a normal day is going to be a little bit difficult. And the world has changed in the last couple of months to make it to where you're going to have a few other things that maybe are going to be more headwinds for you. I think here over the next few months to few quarters as it relates to just generally accessing capital markets. And so wanted to do kind of a little two-part series on raising VC hacks and tricks and things that I've seen work well from myself, from Liam, and as sort of a VC perspective, and then from a founder perspective as Graham, who's raised capital in the last couple of years. And then next week, what we'll do is more of a how to raise venture capital in a bear market, because it is a completely different beast. And there are certain things that I think you're going to be wanting to be thinking about going through that whole process. And so really the agenda, I'm going to spend maybe 5-7 minutes talking about, in general, some of the things that I see of how to get prepared, how to get ready in chatting with VCs for some of you who are getting ready to go through the process again or getting ready to go through it for the first time. And then I want to do 5 or 10 minutes a piece of Liam and Graham talking about their experience of what works well, what doesn't work well, what have your experiences been like on the investor side as well as the founder side. And then we'll go through some kind of prepped questions. And then I want to spend a lot of time on kind of general just popcorn Q&A from folks in the room. So that's kind of the overall background and agenda as we're going through some of this today. All right. So as I sort of separate out the VC funding process into sort of two separate, distinct kind of workflows and patterns, and they run basically one after the other. I think it starts with just getting to a meeting and everything that's getting ready for and get to that first conversation with someone. But then it's, okay, how do I go from first meeting to a full deal closure process? And so I'm going to sort of tackle them in two separate ways and just go through things that I think I've thought through, noticed, as me sitting here who reviews between 500 and 700 pitch decks on an annual basis. And so for you all, and I think everyone here is fairly, you either receive some type of investment or at least fairly well connected with it. When I think about starting and prepping, it is the materials that you're going to be going for. I think a lot of people that I talk to think I need like a 10-slide pitch deck and that's really all that I'm working forward here. And I found that really you need subsets of materials from basically, I want the 10-second version that gets me to the 1-minute version, that gets me to the 10-minute version, that gets me to the 10-hour version. And so that's the way that I sort of view a lot of these things. And so as you're crafting things to start down this process, anything from an initial email blurb, literally like 5 bullets plus a little bit of a narrative that you can use as an outbound conversation starter to get to Liam's inbox or my inbox or something like that. That plus a short little 1-pager on top of all of that, looking at, okay, once I get those done, I'm going to talk through a 5 to 10 slide pitch deck that maybe gets me to a longer, more detailed deck that can be passed around, and then your full data diligence room that exists there. They are separate and distinct, but go through very varying levels of detail. And I think each of them is important as you're going through all of that. I would say one of the hacks that I have found is having a forwardable email that's literally easy enough to send to someone saying, hey, I'd like an introduction to ex-analyst at this VC. Do you have any networks or connections here that this would be valuable for? Make it simple and easy to where they can literally hit forward. Hey, are you interested? Do you want an introduction? And move on. So I would say one of the hacks that I've seen on that side is really having that and using it significantly. From an actual where materials typically look like, one of the things, you guys are familiar with docs and PDFs, PowerPoints. I have found that, at least I'll be curious to see Liam's experience as well. I like PDFs. I like things that are easily forwardable on. Doxin, some of the things that I got to click in and link to. It's this happy balance that some people like it, some people don't like it, but there is definitely you can go through both paths and be good on that front. What I've seen be an interesting little hack right now, and I've only started to see this in the last 6 months, is someone who will use a Loom, which is, a short little video snippet, and they'll actually embed them talking about their pitch deck in an email. So basically it is a, 2-minute video of you talking through your pitch deck. That's basically, I get a chance to not only look at your pitch deck, but I can sort of see you and experience you in a very short window, and get to know you a little bit better. I will tell you, and when I've received those, those have immediately gotten to the top of my pile as I'm thinking through some of that. So just something to think about.
Hey, Quinn, can I stop and ask you a question on that?
Sure. Yeah.
Would you feel the same way about a snippet of a demo? Like it's a clickable demo?
Yeah, totally.
Okay.
In kind of that forwardable email or email blurb, having something that sort of talks to the overall company, and then even like a 30-60 second like Figma recording or something like that. I've seen those work really well for just me to very quickly and easily understand your product on that side.
Okay, cool. Thank you.
Totally. As I think about that, crafting and materials, next step, I think I've sent this to most of you all, but for other folks that'll view this later, there have been created a lot of VC and angel databases that really didn't exist 24 months ago. I think OpenView, Visible.vc, and there's a slew of other ones. Go out and utilize those databases of slice and dice for my stage, my what vertical I'm in, how much am I raising, do they lead? I mean, you can get all of those things down into here's my target list versus just going into the the ether at that point. Hack that I typically see on that, going in cold, it works. I have what I would say, and utilize some of the founders that you see on the call and some of the other folks in your network. Referrals from fellow founders and existing investors, whether you're existing investors or other existing investors you've talked to, for some reason, those continue to make it to the top of the pile. So utilize those where you can, but cold outbound is still a path that you may likely have to go down. And also, if you're going through this for the first time, it's a sales process. 100 cold outbounds gets you 20 conversations, gets you 5 really interested meetings, gets you to 1 check. I mean, they're a little bit skewed in that regard, but you view it very much like that. Don't feel like you're going to reach out to 3 people and get your funding in the door. Additionally, if you've got, I'd say folks who are going to run out of money within 2 months are probably the least, not to say the least interesting, but it's definitely a negative, I think, of saying someone who's in a bind needing money last minute that didn't appropriately plan ahead. Give yourself 6 months of runway. When starting to reach out and run this process, get in earlier is better. A hack that I've also seen as well, if you start early enough also, I think it's a Pitbull quote, if my memory serves me. If you want money, ask for advice. If you want advice, ask for money. So as you're starting to have conversations with investors, think about, I'm not getting them to invest right now. Hey, I'm launching a fundraise right now. Here's some things that I'm thinking about. What are your thoughts on this? Do you feel like I'm approaching it the right way? Building a conversation in that regard, I think, has been an interesting way that I've seen people get people hooked into what you're up to without feeling like you're selling to them to start off. And then the biggest hack that I've seen in general, and this is something that I wish a lot more founders did, monthly friggin' updates. So if you are starting a fundraise in 3-4 months, reach out to people. Hey, I don't need anything from you right now, but I want to get connected with you, and I want you to watch our progress for the next 3 or 4 months. So that way, when I do needing to come ask for you to start with an investment conversation, you know that I'm accountable on a monthly basis, and you know a lot more about me, and you've been able to see and track my progress. So all of those things are certainly something. And honestly, the last one to me is one of the most underutilized ways to get to the top of a VC's inbox. And then once you get to a first meeting, your goal is to get to a yes. So overall for me, be concise. One of the top, someone who uses 25 words when they should use 5 is one of the quickest ways that I think I start to not really understand what's going on there. And I think that's that to me is something that level of conciseness is certainly very appropriate, especially early on. You'll get a chance to dig in later, but don't dig in too deep too quickly. Your goal for this is to get to a second date, not to close a sale or close an investment. And then the hack that I'll throw in with this, you try to drive the timeline of an investment process. VCs have, they are busy, but they can wait a week and a month and 2 months before investing in you. You trying to drive a timeline appropriately and not being too aggressively is something that I think is a hack to continue to go through all of those. It's also a momentum game. Your first check, it's an 80-20 rule. Your first check is going to take the longest. It's going to take 80% of your time to get to that first check. And so continue to use this as a momentum process. And the hack that I've seen people go through it is, if you need $1 million, raise your first 250, maybe at slightly lower terms, get that in the door and let that get you down the road, and then use the next 750, maybe at a slightly higher valuation. And that can get you to your full $1 million and get that initial kickstart going at that point. And then lastly, what I'll say is just avoid the red flags. Investors early in the process are looking for ways to say no, because it's just naturally what we're having to do with so much inbound that we get. So be prepared, use data and milestones when you're talking to them. Don't view it as a salesy sales process. Build a relationship and know that it's going to take a little bit of time. Don't ask us to sign NDAs, and I'll be curious if Liam agrees with my perspective here. Have appropriate and understood market expectations on what you should be raising in your valuation. And then the last thing that I might say as well as this is related to Margin Call. If you guys seen the movie, is talk to me as though I'm a golden retriever. And what I mean by that is speak to me and get me to a level of understanding that a third grader could tell another third grader, and they're going to believe it and understand it. So that's the way that I think about those things. Don't put in the sweat equity early on. Get to a level of initial validation that exists. But don't immediately say, hey, I've got this idea, I immediately need to go raise other people's money to get this going. Put in the hard work to start to put some validation in there, bootstrap it as long as you can, and don't immediately just seek other people's money, because that's a red flag that I think I typically run into. So that was my 10 minutes that I will then get over to a couple of other folks here. So Liam, I want to start with you. You are kind of senior associate with KCRise. People are typically going to be using you as sort of a first conversation with a lot of these discussions and working with the KCRise fund. I just want to hear from you, your perspectives. How is your fund structured? What's the decision-making timeline? What has worked well for you, and what do you care about versus not care about? I'd love to just hear 5 to 10 minutes on your perspective of that, for just how folks can get in the door and get to a yes with someone like you.
Yeah, absolutely, Quinn. And great primer. I agree with a lot of things that you mentioned. I've taken notes on others that I'll kind of chime in on. But you've really kind of hit the nail on the head from the VC side. So I think what I'll kind of add is maybe more details on what it's like from our perspective. And just so you, as entrepreneurs, you can kind of understand the other side of the coin. So for us, very much like it is a fundraising process where you have a big funnel that goes down to small. Fundraising for us, I refer to as deal sourcing. It's a primary responsibility for me at KCRise. Is similarly, we look at a bunch of deals and it narrows down to one, or the number that we're trying to do for portfolio construction. In this case, we'll just say 1 for 1. And it's not always the case that those will line up, but for both of us, it's just a very busy process. And I think what's really important, what's really key to making sure that you can get to the top of the stack and get a meeting or get to the next meeting and possibly a yes. It's just understanding that where deal sourcing is the lifeblood for VCs and volume and velocity really drive that. There can be a lot of noise, and VCs like yourself have a fixed capacity on what they can do and how much they can review. So the key is, how do you get to the top of the deck? And I think Quinn really kind of focused on one that does it big for us, and that would be kind of the warm intros. I mean, in terms of our deal sourcing, a lot of the deals are coming from existing networks, whether it's founders, VCs, our investors. So really trying to find a way to get to someone in that fashion is probably where we see a majority of our deals. And so maybe more fruitful for you. That said, we are out there researching and kind of looking around, checking under every rock for potential possibilities. But a lot of times those are with founders that might not have the network or might not have kind of experience and strategy in order to reach us through a various network. So that's more for us to make sure we're not missing deals. And I wouldn't recommend that as a strategy, but warm intros are definitely key. I think so we're a unique fund in that we have a geographic preference. Other funds certainly do that, but some funds are more industry focused, sectors focused, stage focused, what have you. But it puts us in this kind of unique position, and it'll kind of go into a strategy. But we, a lot of times, are some of the first contacts for people that fall within our geographic preference, including on kind of the outside of that as well, or someone within our network is. So we play this unique role because we also don't lead deals, where a lot of times we are kind of that conduit to the next level of VCs. And we have a lot of co-investors, especially outside the region, that will come in on deals with us or have come in on with deals with us. And they're good people for us to send deals to bounce ideas off of them. And so that's kind of a unique role we play. And I think that that's a product of us being location-based, intimately familiar with people kind of in our geographic space, and the need to kind of find other people to co-invest with. Not always the case for VCs. So some of the stuff I may say today, we may be more willing to make introductions than others, but just to kind of provide a unique layer to what we do. And so I think the big things for me when, and this goes to Quinn's point earlier, that VCs are looking for no's. Sometimes that's just out of convenience, so they have one less deal to look at, but other times it's because the deal doesn't meet their preference. So one of my hacks, I guess, if you will, is make sure when you're reaching out to someone that you've done the research and you address any stated preferences or implied preferences that you're aware of. And so the preferences, I think, can kind of come in two baskets. There's kind of rigid established preferences. So in our case would be the fact that if you are not in Western Missouri or the state of Kansas, absent a very small exception that we have, it can be really difficult, or it is basically a binary decision of yes and no. So really easy way for me to get a deal off my plate is if they just have zero connection to Kansas or Western Missouri. That's a very efficient use of my time. Again, look at other preferences and stated preferences. These rigid kind of established preferences are typically known. They might even be on their website or as part of research, but they shouldn't be something that comes at a surprise. And if they do, there's a chance you may not get to a meeting with them. The next one are a little bit more difficult to kind of identify. And I call these kind of the strategic preferences. In our case, we have a geographic preference, and we have experience in kind of, I guess, expertise in the B2B SaaS space. That's where we really kind of are most comfortable with things. Not necessarily something you'll know, but it is something important to understand as we're considering a deal, because if something falls outside of that, it'll just be more effort and more consideration as we look into it. So these can be more difficult kind of preferences to identify. They'll likely be less clear, but one way to look at these, I suggest, is to go and see what other deals they've done. Similar companies, similar spaces, similar stages. Obviously, you want to be careful of approaching people that have a competitive or slightly competitive type investment in a space that you're in. But certainly a good way to kind of prioritize your research and narrow the universe of potential VCs that are out there is to see who is kind of active in this space. And if it seems like it's maybe something more opportunistic or maybe something more strategic, that's a good way to really focus on those preferences from the outset. Because if I can see in a quick blurb on an email that someone has done their research and knows what we're looking for, that shows me that it could be something worth digging in on and spending more than the 2 minutes that I may have to spare on an intro email. And that's, again, depending on where it comes from, whether it's a warm connection or a cold inbound. But those are kind of the things I think that just in terms of analyzing a deal that come up to the top. I think just to kind of respond to a couple points that Quinn made with the rest of my time, and then we can get into questions. I'm just looking here. So PDF deck, I agree with Quinn. Those are great. Viewable on my phone if I'm on the go, easy to do, easy to forward, easy to store in our CRM and share amongst the group and with others, especially as part of Affordable. What I will say is DocSend is a good thing from your perspective because you get to see who's actually opened your deck and what they've looked at, how much time they've spent on various slides. So it may be a good way to kind of layer those strategies into a small initial deck via PDF. And then maybe before a meeting, you share the deck that you're going to be going through DocSend to see what they've looked at and maybe what they're interested in there. Other kind of thoughts as well as the video may be a good intro, but what I always tell people is when you're thinking about supplementing, or when you're thinking about adding new features, especially a video, which is really cool and innovative, to something that's going to like people that have been in this space for a while, understand that they have certain working preferences. So I wouldn't use a video to replace an explanation for your company that would come from a short email blurb, but it is a good thing to add on there to be an appendix. I tell people that when they're trying to do something unique with their deck, kind of keep it simple and more on the standard kind of approach. But certainly if you have something that's of value, don't just leave or don't not include it. Include as an appendix or something that's supplemental, but not necessarily core to what you're trying to achieve. I think, and another hack, and this is a really good point that Quinn brought up. So the Pitbull quote, which I'm not that familiar with, but if you want money, ask for advice. I think a really good way to kick off a fundraising campaign, especially early on, and to start gauging interest from people you're familiar with, but also see their kind of get their temperature on how much they're willing to share, is solicit feedback on your deck from friendly investors early on. This lets them know, A, that you're considering a raise, B, gives them a chance to potentially express interest, but then also allows them to maybe start thinking through and offer up ways to make introductions as well. Simple advice: can I get feedback on my deck? Sometimes the feedback will be really good, but a lot of times it's that kind of secondary value that comes with it too. Monthly updates, agree, fantastic amount of work, or a fantastic resource. And I think so 2 things on NDAs. I agree with Quinn, not something we're typically going to do. I can think of maybe one exception over the last 8 months where we considered it. I don't even know if we got to the point that we signed it. But as VCs, we're not in the business of creating businesses. We're in the business of investing in businesses. And certainly maybe information we use could be used to help a portfolio company that's competitive to you. I think those are all kind of tenuous examples, but a lot of times just it's not market to expect a VC to take an NDA because there's any concern that some legal liability would hamstring our ability to help a portfolio company or make an investment that comes along in the future. I think that is just too massive of a risk for a minor reward to get an intro with someone that we're not quite sure where it's going to go. So I would avoid NDAs, but I do think there might be circumstances where they could be warranted. And then lastly, I have a perfect use case that we're finalizing an investment now of someone who's been at work since January on this raise, working super, super, super hard to get that first check, to get that lead check. And now things are falling in order really quickly. So to the 80-20 rule and the momentum, and this is a long game and it can take 3 to 6 months, all that summed up in a perfect use case example of just working hard to get that first check, that first yes, that lead, and then things will slowly fall in order to that. So kind of what relatedly to that, maybe work on prioritizing a lead, because one of the quickest ways that someone can kind of put their decision on delay is to say, okay, but come back to me when you have a lead. And that can be really frustrating and really tough, especially as you're trying to prioritize a lot of different aspects of your time during fundraising and whatever else you have going on. But no, I think that was my 10 minutes. Quinn, those go really fast. So I don't know if I missed anything or if you want me to touch on anything else. You brought up a lot of good points. I was just trying to add some additional layers where I could, but yeah, those are my quick thoughts.
Yeah, no, I appreciate that. And those are definitely, it's interesting to see kind of your perspective and agreed on kind of this, be supplement, but be, I heard from you a couple of times, be standard. Like don't, be a way that someone would expect to interact with you and talk with you. And if you want to be creative and new and ingenu and be different in some regard, make sure it's supplemental, but not replacing kind of that standard base on that front. I kind of want to switch it over to Graham. You've gone through 2 fundraisers since COVID started. I wanted to hear your perspective, maybe 5 minutes or so, on just how did you go about doing it? What was the strategy? What did you see work well and not well? And just hear a little bit of your background there. And then we'll basically spend the rest of the time doing some popcorn Q&A after that.
Sure. Yeah, thanks a lot. I appreciate it. And it's I'm obviously giving the founder's perspective, so some of the things might be a little different than what you guys had said, but I think that what all of your information has been awesome so far. And I think that there's a couple important things to think about here as you're fundraising, and there's a pretty different process to how the stage that you're fundraising at. Like pre-seed, usually done on safes or something like that. Seed and beyond is usually done in a price round, and those processes are incredibly different. And then additionally, are you pitching and talking to investors in person or online? Those processes are very different as well. And so I'll try and kind of touch on like all the aspects of it. Starting in a pre-seed, doing things on safes. Luckily, that's like obviously very easy. Like that's why they're used so much, is that it's a very easy process. And you don't necessarily need to have a lead investor when doing safes and all of those things. Some people still request it, but I think going through that process is usually just saying, hey, we're raising this amount of money, we're trying to just get interested parties. There's a couple of different ways of like you setting the valuation yourself, saying we're doing X dollars at X valuation. I've heard a lot of people doing more lately of just saying we're going to let the market decide what valuation we think, because obviously pre-seed round, it's very hard to actually give a valuation, because maybe you're pre-product, maybe you're probably pre-revenue, like you're probably early on a lot of these metrics. And so it's very difficult to actually come up with that number. In my experience, it's been, something that like an investor has come up with. We counter and you kind of do a little bit of negotiation to see where things land. And as far as I think getting in contact with investors, I have seen in my experience, cold outreach I don't think it's ever worked. So it's always great to just really scour your network and get warm intros, or any kind of handoff between someone is incredibly helpful. I do definitely prefer DocSend. I think that when you're evaluating decks, DocSend is very helpful from the founder perspective for some of those tracking things, but it also helps you keep control of the deck. When it's a PDF, they can be shared anywhere. They can they can get into hands that you don't want them to get into, and you have a little bit more control when using DocSend. I have not gotten pushback from any investor by using DocSend. Usually they're pretty like, okay, we'll go with it, whatever. So I do recommend using that. And I think when you think about formulating a deck, really, I've seen decks that are incredibly long and are telling every piece of the story that you have, and that's not what they're for. Investors don't read them. Like they just kind of click through looking at the highlights. And really, so what you need to leverage your deck for is to kind of like tell your story in a very simple way that you can like literally click through, and then try and build FOMO, trying to make the investor feel like, if I don't talk to this person, I'm definitely missing out on something. And that is like the number one thing that you need to use a deck for, is really just driving that FOMO, so then you can get a conversation with them. Once you have that conversation, you can tell them the story, you can dig into all of these things, you can do all this other stuff that you need to do in the process. And so I think that I've seen people use decks, I think, incredibly wrong. And I think that really keep it simple, keep it incredibly like concise, and really just point out whatever metrics that you are able to really showcase, and then just use it to drive that, to get on the phone with one of the investors. I have always, when times of COVID and everything, I've raised all of my rounds remotely, not really seeing many investors in person. And when you're doing it online, it's usually like sending them the deck and then getting on a phone call with them and then, talking through, things, answering questions, whatever. It's less of like the typical pitch that you usually kind of hear about. When you do meet with investors in person, there's probably a little bit more of that pitch aspect where you're like going through the deck and like talking through it, but really doing remotely, I've never actually gone through a deck and explained things with an investor. Usually share it with them, they review it, and then you have a conversation on a call. So those are pretty different processes there. And then when you think about doing priced rounds, this is like a pretty different process. And a couple things that I would say you really want to optimize when you're doing rounds of like getting to like checks in hand, documents signed as fast as possible. And that usually comes with having everything ready to go ahead of time. So there hasn't been a ton of like requests in like the earlier stage for like data rooms and like the due diligence process. That usually comes like after a term sheet's given and you are kind of engaged at that point. So but that being said, have everything ready to go and like in your data room before you even start talking to investors. Because whenever, I didn't do that very well in my seed round. And, as soon as we hit due diligence, it was a big delay of like a week of us gathering all of our documents, getting everything in order with our legal team. And that was just an unnecessary lag that we didn't need to go through. And so have everything ready to go ahead of time. And then I would also level set the expectations of the process. Like as soon as you get that term sheet or you start to really engage in the process. And how that you would usually work is I would recommend to like engage in your legal team of like, explain the process to me. How are we going to do this? How are we going to go through this? And then I would do the same thing with your lead investor of setting expectations of like, how are we going through this process? What are we doing and how are we doing it? And then communicating that with anyone else that is in the round. Because when we did our round, we had like a closing date and our legal team had the expectation that on the closing date, everyone signs documents and wires the funds. Some of our investors were thinking that, okay, that's the start of it. And then you have 2 weeks after it to actually execute on that. And we had to do this last minute rerun of like all of this stuff. And it was a really horrible process. So really setting the expectation of what it is that the process that you're imagining is incredibly important to keep it efficient. Because if you can level set with everyone saying, this is what we're doing, these are the dates you need to be aware of, and then everything will go incredibly smoothly, and then you can have everything in hand much faster. And so I think with all that, I think the biggest thing is just showcasing whatever metrics that you can showcase and just driving FOMO. Like I think a lot of this investing is just getting investors to feel like I'm missing out on something if I don't do this deal, and really telling the story about your vision and what you're doing in the best way. And I think that those are like just the big things that founders need to think about when doing fundraising. Obviously, when you get to later stage, like Series B and stuff, there's a lot more of like, give me the numbers, like how is all this, like the economics working out? But in the early stage, it's much more of that, FOMO storytelling. So I think I'll stop there. And then I can probably have more directed, feedback in like the Q&A or something.
Yeah, that sounds great. Thanks for that. And I think, your commentary around FOMO, every single one of us wishes that we were the first investors in Tesla, in, insert other companies that have just Coinbase, that have just been ridiculous fund returners for something like that. It very much is a, kind of talking to folks about venture capital. It's a power law, meaning we're going to make 10 investments with the full expectation that 5 of them are going to go to zero, 2 or 3 of them are going to maybe return a little bit of capital, and then 1 or 2 are going to drive the significant returns for our fund or for our personal portfolio if you're an angel investor. And so you need to be able to show and make people feel like you are that 1 in 10 on that front. And so, Graham, I think that's a really good comment there. I've got some prepped questions that I think I'll popcorn in a little bit, but I want to just open up the room to Faith, Tona, Deborah, others. What questions do you all have of either Liam or Graham as they were, just in general about hacks of getting to a yes from a founder looking for VC perspective?
Hey, Quinn, can I just jump in real quick as people
Please.
Their questions?
Yeah.
Graham brought up a really good point about safes and then getting to a price round or using a note. through there. I think that's a really good point, especially early on. And I think just from our perspective, VCs are becoming much more comfortable with safes than they would have, than I think they've been traditionally. Just one point of caution, as you're looking at safes, some attorneys get very overzealous in their representation and like to make changes to that. And I think as soon as you start deviating from the Y Combinator form, which is kind of the widely accepted one, it may cause some friction. So just a note there, we had a deal that happened. But on the valuation side, Graham's absolutely right. It's hard to place valuation. A really cool tool though, that I found recently, I'm sitting in the chat, is from Angel List, and they have market data on kind of round sizes and valuations used for safes at pre-seed, seed as a bridge, and then you can kind of boil it down by industry as well. Super cool tool. I don't think it's gospel at the end of the day, but it's kind of nice to have for context if you are trying to figure out what valuation you're going to use and maybe what's market. Because at the end of the day, maybe that's the best kind of metric you have to get there. But that's just the point I wanted to add, because Graham had a really good point about the safes, and I think this tool is fantastic.
Awesome. Yeah, no, that's great. I actually didn't know about this. I'm going to start using it for sure.
Yeah, absolutely.
All right, room. You have two willing people. Grill them with questions. Let's go.
All right, I'm going to start. So this may be remedial, but I'd like to know. So I'm at pre-seed. I'm going to be approaching VC for pre-seed funding using a safe. But can you talk me through just what are the next 3 steps? So are you, I've been asking myself, are you prepared for a yes? And I'm not sure that I am. So I pull out my safe form, and do I already have an attorney at this point who's managing it, I would assume? I don't think I have to have a data room at this early stage. I don't have anything built yet. Can you just, like I said, remedial, but can you kind of step through what you would expect those next steps to be?
Yeah, I have some initial thoughts. I think at the pre-seed level, first off, that's a very highly specialized kind of risk category for VCs. So I'm not sure if you've identified potential contacts. I know it's like a fairly limited field. We've tried to help people identify VCs in the pre-seed stage. Graham, maybe you have experience on this, but sometimes in that you're seeing more friends and family, or maybe non-institutional investors. I think when you do that, and this is relevant because I think as soon as you bring in like an institutional investor, like a VC, there's going to be certain expectations on the safe, and maybe they have changes, maybe they don't. But that could be a time to maybe prioritize legal counsel sooner than later, especially if they're going to be asking for additional rights in a side letter. And especially if you're going to be having multiple institutionals. But in terms of like the next steps, I think, if you have everything ready that you could go into a meeting tomorrow, assuming that's kind of behind you, and you're just trying to prep for the yes, I think to Graham's point, having a very basic data room ready to go, and in your case would be like articles of incorporation, any kind of major agreements that you may have that are key to what you provide. I'm trying to think, you want to have your cap table, have that ready to go. You can have the safe ready to go. The site I sent you, I think there's another link on there that you can even generate a safe from the site. So you can have that ready to go and maybe even get a blessing from an attorney beforehand, so there's less friction when the time comes.
Okay.
But otherwise, I think those are 2 big key tips, especially at the pre-seed level, but you're so early. And I think it's important to kind of really think about your goal for targeting VCs specifically, as opposed to like friends and family, or kind of like an expansion of that at the pre-seed level. But that's just kind of my thought, because I think it layers in a tad bit more complexity.
Right. Okay, great. Thank you.
Yeah, I'll kind of give my perspective on that a little bit too. And I think that when we did our pre-seed round, it was on safes, and I asked my lawyer, like, what do we need to do? And he's like, just use the documents from the internet. And I'm like, okay, like that was easy. So I think that if you can get whatever investor to just use the standard YC docs, it's very easy, and just execute those. Like Liam said, if there starts to do any kind of modifications or side letters or anything like that, absolutely get legal counsel involved. there's things like I always read like the side letters and stuff before sending them to my lawyer, trying to just like educate myself. And I'm like, this seems fine. And then they like redline like all of these things that, like I had no idea, about. So like that's why you pay them. But
that's right.
So as soon as you kind of start to deviate from the standard process, definitely get legal involved. But besides that, it's pretty easy. And I think that Liam had a good idea too of just, your data room's not going to be enormous, but just having those standard things. I mean, no one really asked for those like in my pre-seed, but again, just being prepared in case that does come up would be, help that process out a lot.
Okay.
Yeah, and commentary from me on the YC safe, like try, if your investor pushes for, or your potential investor pushes for deviations, I'd say try to stand fairly firm on this is a standard document, everyone uses them, yada, yada. I mean, I think it would be appropriate of you to say, let's just take standard legal at this point. You are a really high risk investment at this point. Let's not overwork it at these early stages. This would be my thoughts. So be comfortable sort of taking that stance and trying to say, let's just stay with standard documentation.
And just to underscore that point, Quinn, I think you're absolutely right. And just if the investor pushes for something unique or overly complicated, like part of their investment is going to be going towards a legal spend. And like, that's not what we want here. That's not what this money is supposed to be used for. So kind of a point there, but then also understand that as you go through rounds, and this isn't necessarily for a safe, because you may not be using a safe over and over again, but setting kind of terms, especially non-standard terms in a safe, kind of creates an opportunity for precedent to be used in subsequent rounds. So if your initial investor comes in, and whether they're sophisticated or not, and creates maybe an investor friendly term, and is trying to push that in the YC safe, or the YC safe that's not there, that could set precedent. But also if someone at the seed and Series A round is reviewing a safe that's going to convert, they may have questions about that too. So I think just for a lot of reasons at the pre-seed level, just stick with standard. It's widely accepted in the market. And I think it avoids a lot of headaches and costs.
That's really huge advice, especially for a lot of Wichita angels who aren't used to seeing some of these safe notes, just from personal experience. So sure. Definitely use safe if you can. I had a question, if I could jump in. And maybe this is for Graham. Liam, you can maybe potentially you as well. But I'm just kind of curious as far as like how to get a term sheet faster, right? Like I know that you guys talked about like driving the timeline and everything, but I think that obviously, getting that term sheet gets things rolling a lot faster. So I'm just curious if you have any advice around that.
Yeah, no, definitely. I think that's something that I didn't do well in my seed round. I talked with a lot of people and it took a while. Like there's a lot of that, we're interested, come back when you have a lead, and like we'll do that. So I think that what I would have done differently is, I think Quinn's point earlier of like not even approaching investors of like, hey, we're raising a round, we're interested in a lead, we're looking for a lead, whatever. Just like, hey, we're thinking about this in the next 6 months to a year, getting feedback on your process, your deck and everything, and just getting checking the appetite there. And then from that, you might just get like someone that is interested enough to just, give you a term sheet or something. So I would start with that. And then I think just trying to being very focused on like the types of people that you're reaching out to is very helpful as well. Cause like there's some investors that just won't lead rounds. They won't give term sheets or anything. They'll happily participate, but they just, won't do that part. And so I think just knowing who you're talking to and who you're targeting of, your industry, whatever, all those things, and being very, being very targeted in that, I think will be very helpful as well. And then of course, like I said earlier, like the FOMO of just like get some metrics, really showcase those metrics and really, make them feel like they need to get on this train or be left behind kind of thing. So I think that those three things of just like starting the process early and not even like, I think that going to them and saying, we're looking for a lead investor is maybe not the right move, or just saying we're interested in maybe doing a round in a while, like looking for your feedback.
Yeah. And Deborah, I agree with Graham. I think those like really good approaches to it. I think there's like a couple phases to getting to that term sheet. The first just being just the prep, or this kind of like pre-phase, because like when they're going through their diligence. There's various VCs have their various processes. And so like they'll have to do certain things. And the only real way to kind of expedite that process is just to be as ready and responsive as you can during that time, and maybe push them to get something done in 1 week instead of 2. But if you can kind of get a running start into that phase with kind of getting your deck and soliciting feedback from a handful of specifically identified potential candidates, can be a way for them to start getting that on their radar. And maybe they can start shortcutting some of that diligence, reaching out to customers, prospective customers, et cetera, in a way that can get you there first. And then on the FOMO side, like obviously make them feel like this is the deal they can't miss. But we've seen on a recent deal that there was just a struggle with a term sheet. And then as soon as there's one term sheet, 2, 3, 4 more came in. So that's when you really start driving FOMO and things will go quickly. But obviously it's hard to get more if you can't get the first one to fall. But I agree with what Graham said.
Yeah, and what I'll add in is on the on kind of the monthly update things that you're doing. Back to, both of these guys have said, use your fundraise items. If diligence and getting to a term sheet will take longer if they don't already know you. So if you are a first-time fundraiser, get those monthly updates, show that you can be accountable, show the progress, so that way when you come back with the, hey, I'm launching a round, they already know you, and there's a level of trust and conviction that they may already have walking in the door. And then if you're coming in for a second fundraise as well, continue to do that. And I tell folks, if you're going down the VC track, you're going to be raising multiple rounds of funding. When you finish your seed, when you're getting through your seed fundraise, start to engage with Series A and say, hey, I'm doing a seed round right now. You may not be a good fit for me right now, but I want to talk to you a little bit right now, so that way you can track me up to the point to where they already are starting to feel some of that FOMO before they even really naturally get in. So that'd be the other kind of tactical item I'd put in there as well.
And I kind of thought of something while Quinn was talking about that too, of just like, there's some like strategies and tactics that you can do of like doing those like monthly updates, and like having like one of your it's obviously in your existing investors' interest to like, get you to that next round. And so we've had like some of like your existing investors like sharing the monthly update with your permission with an investor, and it kind of feels like this exclusive secret thing, but it's kind of strategic to like get them to get a sneak peek and get interested in all those things. So there's some tactics you can use with your existing investors to help set you up for a larger getting into that term sheet territory.
Yeah, and that could be your existing investors or your board as well.
And if anyone's looking for a good example of a monthly update, QuickHire does a fantastic job. So I'll just throw that out there. And we use them as examples with our other new portfolio companies of a good format to use.
Right. On that same note, I've got a couple questions here, because I'm at the same stage probably as Faith is, and I'm pre-seed here, but just thinking about doing my first fundraising round coming up. I'm introduced to a couple of new terms here, so I'm sorry to be a little remote here, but on this, data room. What is in a data room, and where do you store this?
Yeah. I can take the lead on that. So a data room is just basically an online repository for key documents. It's a big catch-all term, but as you go through various fundraising aspects, especially as you proceed into like Series A and beyond, your investors are going to want to dig in to what you have as a company, whether it's formation docs, key agreements, stuff that they would expect to be in place for best practices, as well as legal requirements are going to populate that data room. There's a couple different options. I mean, I've seen people use Dropbox, where we use a data room when we're going out to fundraise from our investors, and we're using DocSend. I'm sure there's some other ones that you can use. But I guess early on, I think
Docs.
What's that? Sorry.
Is Google Docs a decent place to?
I haven't seen one use it, but yeah, here, this is a great example right here of kind of what you would see in a data room. I'm not sure what's in those folders, but this looks like a slightly mature. Yeah. So, I mean, this is like great, and this is great organization.
Yeah.
So this is what it looked like.
Yeah, and when we did our seed round, we did use Google Drive, and just stored all the files in Google Drive, and that was more than sufficient. Our lawyers even like set that up, so it was I got that sign off for it. So that, and then pre-seed round, like we said, your data room's going to be pretty minimal, corporation documents, whatever. Like if you've had previous safes or anything, get those in there, and then as you move along, you'll basically put everything in there. They want to see, like, do you have contracts with customers? Do you have contracts with partners? Like basically kind of any kind of legal document or anything like that should be in there. Balance sheets, all of those things. And maybe it could be that your balance sheet might be easier shared out of QuickBooks or something, and have that might be separate. Maybe you export it, put it in there. So there's a couple different ways, but really it's just that store of all kinds of all of the documents that you would imagine an investor would want to see.
Yep. And I'll share that link, by the way. I've got some links that I'll share out at the end of this for everyone, but a link directly to kind of, again, they said very mature, you're going to want only small tidbits of some of that, but I've sent this template out to a bunch of folks, and you just kind of piecemeal what makes the most sense for you.
Yeah, at the pre-seed level, I would also include, because you're pre-seed and like Quinn was saying, a lot of this you may not have just yet, but stuff to tell the story. So even if you have a sales pipeline, people that you're talking to, things like that, you could put in there too, because they're like, okay, they're not revenue generating yet, but look at all this potential business that could be coming in the door. So stuff like that.
Okay. When you're putting things out, Quinn, if anybody also has a sample of a term sheet, that would be great too.
Yeah, I think I can find. Yeah, I think if you've not looked, if you're looking for documents as well, just general standard documents, obviously the Y Combinator safe is publicly available in VCA, Nancy Victor CA. Those are fairly standard market documents. I think it's nva.com or something like that. They've got, I think, like template term sheet, template subscription agreement, template, some of those other things. But that would be a good one to go and check out if you're looking for examples there.
In quick note, the term sheet should kind of correspond with the security you're trying to issue, right? So there's a term sheet for a safe, because it's not going to have as many terms that you want to agree to beforehand. And then if you're doing a price round, there'll be a term sheet on NVCA, which NVCA is not, it's a good form. It's probably not as widely accepted as a safe, but from a VC's perspective, we like to see those because they're created by our national organization. So they tend to be VC friendly. Yep.
And when I go ahead and I put the link in the chat, and I'll include that in the links that I'll share it afterwards as well.
Super. Thanks.
And there is a template term sheet in there.
Okay, thank you.
Liam, Quinn, I have a question. And it also helps since you guys are kind of on our cap table too. But this may sound silly, but is there a process that we need to follow with our current investors to let them know that we're preparing to raise or currently raising? What is the protocol there?
I don't know if there's necessarily an inherent expectation. I think for a couple reasons, you'll want to just bring your cap table kind of up to date on it. First, as we've kind of talked about, they're going to be opening to possibly a new network of investors. Like your previous raises, you've been focusing on a certain universe, and now you're going to be focusing on a new one. So they can be tremendous value add. And as someone on your cap table, we're invested in your success in a very figurative sense. But then also, then it kind of begs the question of maybe there's a situation where you don't want someone on your cap table. I think in terms of signaling for next rounds, I do know that it can be an issue if someone doesn't come in again. Perhaps it's out of preference or their focus, but if it's not, then that kind of raises issues. So I think for the reason that it opened doors, but then also you don't want to miss out on signaling, it's good to just keep them apprised of what you're doing early on. But just some of our other portfolio companies, they will reach out to us months in advance of before hitting the fundraising trail. Basically, as soon as they get a first draft of the deck together, they send it to us for feedback, and we start having conversations. And we make it a point to start opening up our Rolodex of VCs pretty early for those initial conversations as well.
Got it. Okay, that's helpful.
Also, just for folks, I'm going to go ahead and we're going to keep going here for a little bit. It is 11 at the top of the hour. So if you've got a hard stop or something, just wanted to give everybody a note that it's for a time check on that. And Deborah, I think when we typically get involved, I would say, yeah, I mean, those monthly updates that people send out, that's when I typically hear about them. Hey, we're thinking about raising a bridge round or raising our next round in the next 3 or 4 months. Just wanted to let you all know so that way they can start planning and thinking through that. Some early investors may not have pro rata rights. And for folks that maybe don't know, basically it's a term that exists in when you make an investment that says, if you raise another round of funding, I get a chance to participate, basically. So if you do have those in line with your existing investors, there's a natural kind of standard flow that they get a chance to make some amount of investment while you're going along with it. And so just as you're going through your operating agreement or existing financing documents with legal, just know that there may be a little small process that you might need to follow with some of those if they have those existing rights.
That's a good point, Quinn.
Right, that's helpful. Yeah, I basically wanted to make sure that, like, if I were to put it in our monthly update saying, hey, we're preparing for our next round, I just didn't want it to be like, dang, why didn't you reach out to me directly? I didn't know if that was whatever. But anyway.
No, I think that's, yeah, go ahead, Quinn.
I was going to say that's a fairly comfortable way to introduce that to people. Okay. And then you can have one-off conversations following that if you need to.
Okay.
Yeah, my only thought is like there may be personal preferences, but it's hard to accommodate every single person. So
yeah.
If you know someone who like kind of prefers being in the know sooner, then maybe prioritize that. But no, I agree with Quinn on that regard with respect to the newsletter.
Okay, perfect.
That's good.
All right, final questions from the group here. Awesome. All right, I'll go ahead and